For years, the headlines have been a relentless drumbeat of record-breaking sales. A 5-room flat in Payoh for $1.5 million, a loft in Dawson for $1.4. It felt like the sky was the limit. But while the media was busy chasing the outliers, a quiet tectonic shift just occurred in the Q1 2026 data. For the first time in years, the broader HDB resale price index didn't just stall, it dipped by 0.1%. It sounds small, but in the world of Singapore real estate, this is the first crack in the dam. Today, we're looking past the FOMO to understand why the million-dollar flat has become the ultimate psychological trap.
Let's look at the numbers no one is talking about. While Q1 2026 saw a handful of high-profile transactions, the median price across 22 of the 26 HDB towns actually softened. This negative 0.1% isn't a rounding error. It is the result of the 2024 and 2025 cooling measures finally catching up with market liquidity. The loan-to-value limits and the tightened total debt servicing ratio have effectively lowered the ceiling of what the average Singaporean family can afford, leaving those who bought at the peak holding an asset that has stopped breathing.
Why do we still see million-dollar headlines if the market is cooling? It is a phenomenon called the mirage. Sellers in prime areas are still listing at record prices based on 2025 sentiment, but the time on market metric has surged from 28 days to 74 days. Transactions are stalling. Buyers are looking at the price tag and walking away because the bank valuations are no longer supporting these prices. If the valuation comes in at $900,000 for a $1 million ask, that $100,000 cash overvaluation is a gap most young couples simply cannot bridge anymore.
The trap is built on the exit strategy. Many buyers of million-dollar flats assume they can sell it for $1.2 million in 5 years, but the Q1 2026 data suggests we are entering a period of price stagnation. If you buy a flat for $1.1 million today with a high interest rate and the price remains flat for 5 years, you aren't just breaking even. You are losing hundreds of thousands in interest, CPF accrued interest, and opportunity cost. You aren't buying a home. You're buying a liability masquerading as an investment.
We need to talk about the 99-year lease clock. Many of these high-priced flats in Payoh and Queenstown are already 15 to 20 years into their lease. In 2026, the market is beginning to price in lease decay more aggressively. As the remaining lease drops below 70 years, the pool of eligible buyers shrinks because CPF usage becomes restricted. You are paying premium prices for an asset that has a built-in expiration date that is becoming more visible with every passing quarter.
The 100,000 units. Between 2023 and 2025, the government ramped up BTO supply to record levels. In 2026, the first wave of these prime location public housing units are nearing completion. When supply increases, the desperation that fueled the 2022-2025 price hike evaporates. Buyers who were forced into the resale market now have options again. The scarcity premium that supported million-dollar prices is being systematically dismantled by the HDB's own construction schedule.
Look at the heat map again. The red zones where prices are dropping fastest are the non-mature estates. Yishun and Jurong West are seeing price corrections of up to 2% this quarter. Why? Because the gap between resale and new BTO became too wide. When a resale flat in Yishun cost almost as much as a BTO and a better location, the market corrects. We are seeing the flight to quality, where only the absolute best units hold value while everything else starts to slide.
In 2021, you could get a mortgage at 1.2%. In 2026, we are looking at a reality where 3.5 to 4% is the norm. On a $1 million loan, that difference is catastrophic. It adds thousands to the monthly repayment. This is the anchor dragging down prices. Sellers want 2022 prices, but buyers only have 2026 budgets. This stalemate is what caused the negative 0.1% dip. And as more sellers are forced to move for life reasons, they will have to blink first and lower their asks.
The $1 million mark is a psychological resistance level. For a buyer, it's a badge of status. For a seller, it's the ultimate goal. But once a market hits a psychological peak and fails to sustain it, the correction is usually sharp. We are seeing negative wealth effect. When homeowners see their neighbors selling for less than $1 million after expecting more, they panic list. This increases inventory and accelerates the price drop. The FOMO has officially turned into FOPO, fear of picking up the bill.
Imagine buying a 5-room flat in Pungal for $800,000 in late 2025, thinking you're getting in before it hits $1 million. Fast forward to Q1 2026, and the neighbor's identical unit sells for $770,000. You are now underwater on your valuation. This isn't just a theory, it's happening in the OCR regions. The safety net of HDB prices is being tested, and for those who over-leveraged, the net is looking very thin.
If history repeats, this 0.1% dip is the lead indicator for a 2-3% correction by the end of 2026. As the government continues to signal that HDBs are for living, not for speculation, the investment premium will continue to bleed out. We are moving from a seller's market to a fair value market. The smart money is sitting on the sidelines, waiting for the Q3 data to confirm the trend before making a move.
So, is the $1 million flat a trap? If you're buying for a 30-year home, maybe not. But if you're buying for capital gains in this environment, the data says you're walking into a minefield. The price drop has started. Don't let FOMO dictate your financial future. In a cooling market, patience isn't just a virtue, it's a profit strategy. Watch the data, not the headlines, because in 2026, the biggest winner is the one who didn't overpay.